We are here with another guest again, live on Facebook on multiple different feeds. Like I mentioned a few times, this is probably the last one I'm going to do live on all the feeds. From this point on, I'm going to be doing them at a certain time of day on the Flip Talk podcast with Don Costa page. So make sure you're liking that page if you want to see these things when they come out, and they'll generally come out about a week or two before they actually air on iTunes. So if you want the information before everybody else, make sure you're liking the Flip Talk podcast with Don Costa page. And if you have questions, make sure you're going there to the live feed and asking your questions there, because that's where I'll be able to see them moving forward. So a few things business-wise, obviously, for those of you who are watching live, I have released the Rookie Playbook. It is a course for a new or aspiring wholesaler, somebody that's newer in the business. And we are going to actually do live interactive Zoom calls every single week. And we are also going to be very active in the group, dropping videos and documents and everything you need to be successful. It's my mission to make sure that we're changing lives, and we're going to be doing that in that group. So if you're interested in that, it's priced at a price that we're never going to do it again, because this is the first round draft of Rookie Playbook, and that's $14.97. I'm going to throw it out there. You'll never see it again. So go to rookieplaybook.com and check that out. And with that said, I'm going to go to my guest, Gino. How you doing today, buddy?
I'm doing good. How are you, Don? Thanks for having me on.
I'm doing great, man. So excited to talk to you. We're going to talk multifamily and scaling multifamily and that kind of thing. But before we get into that, you started when? When did you start, and what did that look like, and why did you get into it?
I basically started back in 2002. I had a restaurant for years and years with my family, and I was just desperate to make some passive income. At the time, I had a couple of kids. I've got 6 kids now. So for me at the time, I just wanted to put my money to work. So I chose a 3-family in New York right next to my restaurant. And I started, and I said, I like this. I don't want to fix and flip. I don't want to wholesale, because I already had a full-time job, a really demanding job. So I went out there and did what everyone said you should do. Go out and buy multifamily, go out and buy apartments, go out and buy real estate. And I did that. And actually my first investment was pretty successful. I just exited it 6 months ago, held that thing for 17 years. I loved it. It was a great investment. My problem was, after that, I just started going to niches that I had no idea what the hell I was doing. I went into a mobile home park. I crapped out on that thing. Then I went and I got into a strip mall about a year after that, crapped out of that. And then I said, time out. I am making massive action. I have no education. And we say, Jake and Gino, education times action equals results. That's the bottom line. I was taking this massive action, but I was being an idiot. I was being reckless. You know, a person with money meets a person with experience. The person with the experience gets the money, and the person with the money gets the experience. That happened to me twice. I said, I'm not going to be a fool the third time. My dad always told me, don't be an idiot 3 times. So I said, okay, I'm going to go out and I'm going to invest in my education. And that's what I ultimately did, Don. I went out and I got coaching. I went out and spent a lot of money on my education to coach, because I wanted some type of system, because real estate's not rocket science. I mean, It's cap rates, NOI, networking with brokers, having, money, raising capital. And everyone thinks it's really difficult. It's not. It's really psychological. It's all about the fears that we have. And we can talk about the fixed mindset and the growth mindset. I had enough pain in my life, and I'm like, dude, I need to do something different. I've got a big family. Everyone's telling me I got to pay for my kids' college. I got to pay for my kids' weddings. And I'm like, I'm not making enough at the restaurant. The Great Recession really took a bite out of everyone's butt, including mine. And I'm like, what do I need to do? The other thing that really was a paradigm shift for me back in 2014, I went to coaching school for personal development. And anyone out there who wants to get into investing, first thing to do is get the clarity. Why are you doing what the hell you're doing? Why are you wholesaling? It's a great niche. But why? Why not look at multifamily? Why not get some of that money you make in wholesaling, put it aside, and start buying little apartments for yourself? You don't need a 100 apartment complex on your first deal. Buy the 3-plex, buy the 4-plex, get the proof of concept. And then from there, don't worry about where the money's going to come from, because it will come once you become successful. Let's not worry about that. Let's worry about learning how to do something before thinking about the end in mind. Does that make sense?
It does. It does. Absolutely. And, we talk about that. It's been kind of a theme on the shows that we've been doing recently about understanding why you want what you want. Because a lot of us will get into wholesaling or rehabbing or even multifamily with a goal of making money or a goal of freedom, right? But we end up building a prison. And in any platform, right? You can build a prison in multifamily and commercial investing as well. So knowing your why behind what you want and what your ultimate perfect day looks like, what your perfect year looks like, what your dream looks like, what your end goal looks like, will help you build the right business. So I agree with that 100%.
So for me, multifamily is one of the best vehicles. So I just fell upon it and I started doing it. Now with the coronavirus going out there, people still need a place to live, right?
Right.
I mean, I don't know what's going to happen ultimately. Maybe people can't go to work and they can't pay the rent. But for right now, it seems like a pretty safe bet. There's three basic human needs. It's food, clothing, and apartments. We need that. You can't buy it on the internet right now. You couple that with the habits and with the demographics of 72 million baby boomers, 72 million millennials. Those two groups are renting. They're having smaller families. They're not like Gino having 6 kids. They're having kids at a later age. They have a ton of student debt. Baby boomers are coming from New York and New Jersey. And what are they doing? They're selling their homes, buying RVs. And they're even just coming down to Florida and renting. So it's just been a deluge of demographic shifts about trends and also about where money's flowing. And on top of that, you look at the tax benefits, the cost segregation we can get into that allows you to take the depreciation, bonus depreciation day one, the ability to cash flow, the ability to control that asset is what I love with multifamily, but ultimately it's also scalable. It's scalable and you can build a business with it. You know, business building is people, systems, and culture. If you can figure that out and you can treat multifamily as just, and it's even the wholesaling business and fixing and flipping, if you can think about them as businesses, you won't be stuck in a prison because even though you might have to work hard, I'm doing what I love to do. I mean, I told you this is going to be my second podcast today. I'm going to be on my third. The real estate has allowed me to build the business and has allowed me to do what I love to do. Even though I'm still working hard, my plan was to move down to Florida 3 years ago, retire, go to the beach. That lasted for about a week. And I said, have to do something. So I gravitated towards what I love to do. And I was able to start dictating and delegating stuff that I didn't like to do and start hiring people to do that. Now, is that hard? Probably the hardest thing in the world for me to do because I'm probably like you. You're an I'm a guy. I'm going to do this. I'm going to do that. And that's why I'm stuck in prison. But if you can figure out what you love to do, focus on that. And I think multifamily is the vehicle to allow you to do that. It really is. Once you start scaling up and buying units and being able to hire property managers and full-time maintenance techs and not get stuck in that daily grind and really build a business, I think it's one of the benefits of multifamily that not a lot of people don't talk about.
Yeah. So you said a lot of things in there that I agree with. And you said a lot of things in there that are going to like be way over everybody's head. So I got to unpack that conversation, but
sure.
But I do I do relate. And I think a lot of people on here will relate. Like when I sat down and thought about like what my end goal was, it wasn't retirement. Like I am self-aware enough to know that I will be building businesses and doing this kind of stuff until the day they find me lying dead somewhere. So because it's what I like to do. Idle hands for me don't work. And I agree. And but again, it's knowing what that what that looks like. Like I still don't want a prison. I want to be able to enjoy what I do, and that's something that I agree with you as well. And I think the audience needs to hear that as we build these things, I think it's okay to be a little bit of a workaholic, honestly. And some people might think I'm crazy, but that's my hobby. I don't golf. I don't do those things. I like to do this business. And then I love spending time with my family and camping and going to the beach and hanging out. So that's my balance. And it sounds like you're very similar.
Well, I mean, right now, 10 minutes before the podcast, we homeschool our kids. So I was doing some homeschooling with one of the kids right now, 10 minutes before I got on. And then 3:00, I've got a podcast at 2:00. I got a call at 4:30. I'm going to play tennis with my daughter, come back here, and I have a mastermind call at 7:00. So I'm working probably just as hard, if not harder, but I love what I'm doing. And it's really not about the money. Profit's the fuel. It's not the destination when you start doing something you like and when you become financially free. And I think that misnomer retirement is a joke because when from 30 years ago, you pack it in, you're 62 years old, you're basically going to be dead at 64. Nowadays, people are living into their 80s and 90s. And if they can really create a skill or something, I can always coach when I'm 65 or 70 years old. I still will be able to do stuff. I'll still be able to add value to people's lives. And I'll enjoy doing that. That's something that I like to do. So I think we've been trained to have that employee mindset. And we've been trained that things, if you have to work hard for something, it's not great. Working hard is something that I've always done in my life, and working hard produces a lot of really good stuff. Ultimately, you have to learn how to work smart too, but nothing comes out of something without working hard.
Right. Agreed. 100%. So, and then for those of you listening that want to do this because you want to spend 90% of the time on the beach and delegate everything, I mean, you can accomplish that too. I don't want to say you have to. we just, we like what we do. So
no, you're right, Don. Yeah. No. Let me make that point. With multifamily, you can get third-party property management. You can delegate a lot of that out, but you still have to know how to manage the manager. You still have to have your cadence of accountability where you have your weekly calls, maybe your daily huddles with your property management company that you're getting third party. that is all achievable. But when you first start out, there's a lot of hard work to be involved and a lot of hard work on how to learn how to actually manage these properties and manage people. And if you can manage properties and manage people and hire a third party, if that's what you want to do, we just created our own property management company. So Jake loves that aspect of it. It's like his little baby. He's created it. We've got over 50 employees right now. So it's awesome. We love that. We're able to control the process. We're what we call vertically integrated. We have all aspects of it. We have an education company. We have the property management company. We have a syndication company now where we raise capital. We have a capital company where we're doing mortgages for our students. So it's really a symbiotic relationship that's created for multifamily. But, Don, for all of the people out there that are in single family, you can do the same thing once you start out. You can achieve that if you're willing to share the pie, if you're willing to bring other people on and other partners on, but it's something where you can gravitate towards. And what I did is I like the education. So I do education day to day and Jake does the property management day to day. And then we cross paths throughout the day. Hey, how can I help the property management team? And Jake, I need you to do a podcast with me. I need you to do some content with me. So it's a lot of fun. And what's amazing is the education helps the rest of the companies because I learn new techniques. I learn new vendors. It gives us credibility. The brokers like us. They hear our podcasts. They read our books. So it's a really weird symbiotic relationship that we just stumbled upon. I'm sure people have been doing it for millennia, but I was like, wow, this is pretty cool. It works really well. And if you don't worry about monetizing it so much as being able to, bring value to people, you'll create so many different kinds of brands and so much value that you will not be able to monetize it.
So tell me this, on the apartment and multifamily side of things, when we are, when we're trying to get into it and we don't know what we're doing and we're clueless, right? Because it's not something we've tackled before. Like what are some of the things that people struggle with? Obviously evaluating a property is going to be one of them. So what's a quick and dirty technique for evaluating a property and coming up with like cap rate, and why is cap rate important?
So before I answer that, I just want people out there to know that what you don't know hurts you. Because when Jake and I first started, all we knew was we have to buy stuff ourselves. We knew nothing about partnering with people. We knew nothing about JVing with people. We knew nothing about the word syndication, where you're raising capital from others. We knew none of that. And we were lucky. Within the first 5 years, we accumulated 1,000 units, just ourselves internally, being able to refinance and roll the money into the next deal, right? If I had known syndication, I would have probably tripled that, but that's what I didn't know. As far as when you start out in real estate, I think we like to teach the 3 pillars of real estate in our education company. I think this is what all the students and everyone listening should really think about and really assess on a deal. Take a holistic approach because every deal is unique. But I think these 3 pillars are really important. The first one is the market cycle. Where are you in the market cycle? And this is true for single family home owners also, as far as multifamily. At different parts of the market cycle, you're buying different assets. So right now in the multifamily space, a lot of the markets are in the expansion / hyper supply phase. We're really at the top of the market, right? So we're trying to buy assets and properties that are a little bit newer, that have a little bit less CapEx work involved. Because right now, if you're at the top end of the market and you're putting money into this deal and the market takes a sideways dive, all of a sudden you're losing a ton of value on there, right? That's one of the problems that we see. So you really need to know where you are in the part of the market cycle. I think the second one is your exit strategy. What are you doing with this deal? Are you going to refi this deal after 6 months or after 12 months? Are you going to sell this deal? Are you going to flip it? Or are you going to hold it long term? You really have to know what your exit strategy on that specific deal is. When you syndicate a deal, most syndications in multifamily are shorter term holds, they're 3 to 5 year holds where the syndicator buys the deal, he repositions it, he adds value to it, he raises the net operating income, and then he adds value to it, and then he sells it out. And then on the back end, when he sells it, he splits the profit with his partners. That's where he makes the majority of his money. They just have to know what their time horizon is, and they have to know what their exit strategy is. And the third component is debt. What is the debt look like on this property? Is it going to be long-term fixed rate financing? I mean, that's why multifamily is great right now. I mean, rates are 3.5% for 30-year, 10-year fixed, 30-year amortized debt with 3 to 5, 6 years of interest only. So know what your debt's going to look like. Are you going to go a short-term debt bridge because you're going to refi that, or sell it short-term? What's your prepayment penalty going to look like? So take a holistic approach and look at all 3 of those when you're assessing deals, because we just closed on a 52-unit deal 2 weeks ago in Knoxville. It was a great deal because it was a 1990 build. We were buying it $25,000 to $30,000 per unit below replacement cost. So we're really insulated. It's brand new. I mean, we have nothing. There's no capex involved. There's nothing. We're just going to move right in. Rents are about $200 below market because it's a mom and pop owner. Mom and pop, he's owned it forever. He's built it himself. He doesn't know what rents are. He's the type of landlord that's like, you know what, something's wrong. Don't call me. Just, I won't raise your rents. And they're $200 below market. We're going to go to $900 a month in rent. So that's what we're doing. We're raising that. So that asset is nice in this market because we're going to get long-term fixed rate financing on it. We're holding this thing for the long term. So if the market does take a hit, I don't care what the value is in real estate unless I have to sell or refi. So if it goes down the next 3 years, I know to recover long term, I'll have enough income in there to pay my debt off, right? And at the same time, I know it's going to appreciate, and we're buying it substantially lower than what the replacement is to replace an asset like that. Does that all make sense?
It does, but I think it's still like too too much for somebody who. Now, for people who are in multifamily, I think it makes a lot of sense. For people who aren't,
so for people who aren't, this is what I would say, Don, when you want to start out. I mean, I don't want to talk about education, but I learned all this from mentors and from coaches. And just take it slow. Start going to meetups, multifamily meetups. Start going to multifamily conferences. Start just listening to people on podcasts. Start reading books. I've read countless books. There's a lot of books out there. And then what I want people to do is start small. Think big, but start small. Because when you start small, you can get that duplex. You can house hack that. You can buy the triplex. It's still residential financing. You're getting in the game, and you'll learn the process. And you'll actually say to yourself, I can do a triplex. If your goal is to buy 100 units year one, and you're like, I can do it, but you really can't do it, you're never going to do it. So I started small. That's the first thing. I think the next thing, Don, is people have to select the market. If they're going to invest in their backyard, great. Invest in your backyard. If not, you have to select one or two markets, because you'd said something about brokers. The deal flow in multifamily is really through the brokers. So if you're spread out and you're selecting 5 or 6 markets, you're not going to really know the markets that well. You're not going to know what the job growth is. You're not going to know what the population growth is. You're not going to know where the path of progress is in the market. You're not going to know what the valuations are. As far as you had said, cap rates in, let's say, take for instance in Jacksonville, where I live south of Jacksonville. There are 9 different submarkets in Jacksonville. So the average cap rate in Jacksonville can be, let's say, a 6 capitalization. But certain parts of the city may be really higher because they just suck. Like the northern part, it might be more depressed. So it might be an 8 cap. But the south part near the beaches may be a 4 cap. So that's why when you select one market, you really have to own that market and know where it is. And then obviously, once you start doing that, getting offering memorandums from brokers, getting all that information from brokers, and start digesting the information, and then start calling brokers, and then start going on property tours, because brokers won't take you seriously until you go out there and visit these properties. Because everyone's from California is picking up the phone, calling people in Jacksonville, saying, what deals you got for me, and not building that rapport with the broker. You have to build a rapport with the broker and go look at these deals.
Okay. What's what when it comes to cap rate, again, going back kind of to the original question, when it comes to the cap rate, why is that important? Because one of the things I want to flesh out here is the difference between evaluating single family and evaluating multifamily. Like, single family, you take and you look at all the properties in the neighborhood, or within a quarter-mile radius or half-mile radius that's sold, and you're looking for comparables that equal similar properties, equal to the square footage and bedrooms and whatnot, that have sold in a certain circle, that we can compare it to, and we can say, okay, this one sold for X, so ours will sell for X. Multifamily doesn't necessarily work that way. So let's break that down. How is multifamily different, and why is that important?
Well, the great thing about it is it's the control, right? I mean, it's the control where I can raise what we call the net operating income. And the net operating income is the gross income less your operating expenses. And that gets you the NOI. So if you're able to add rents, add income to the property, whether you're increasing laundry, whether you're putting in pet fees, whether you're increasing application fees or late fees or raising rents, if you're increasing that income, and conversely, and or decreasing expenses, you're increasing that in net operating income. Now, a cap rate is basically a rate of return without any debt on it, because you want to be able to compare one deal with another deal, right, in just relative terms. Now, people say lower cap rates stink. I want a higher cap. When you really think about cap rates, higher cap rates denote more risk, believe it or not. So if you're looking at a market with a 10, 11, 12 cap, there's implicitly more risk in that deal. That's why the cities like LA, New York, San Fran, they have lower cap rates, because when you're an investor, you're looking at those cities, those are metropolitan cities, rents are rising, there's quote unquote more stability. So those markets tend to have lower cap rates. Also, cap rates have an inverse relationship. When cap rates go down, prices go up, right? Because your rate of return is going down, you're paying more for that asset, right? So, and the hardest thing to think of with cap rates, when you have a property, let's say property with a 5 cap, trying to make this as simple as possible, because this is really hard to understand. People are paying more for that property, but if you are adding $1 of value to that property at a 5 cap and adding $1 value at a property at a 10 cap, you're doubling the value of the property at a 5 cap, because it's worth half as much. So trying to figure out, if you look at the NOI to get the cap rate, you're doing NOI divided by the price, net operating income. So if your net operating income is $100,000 on a property and you're paying $1 million for the property, it's 100,000 divided by a million, it's 0.1, right? Now, if you take that same $100,000 and the property's $2 million, the cap rate is 0.05, right? So when you're adding value on that property at the 5 cap rate at the 5 cap, you're adding $1 on that property, you're doubling the value of that property as opposed to a 10 cap. So people focus on the cap rates. Oh, I want a higher cap rate. Don't focus on that, because if you're a value investor and adding value to the property, you're gonna put gasoline on that fire, because it's actually going to elevate more. What I want people to focus on is you trying to buy properties at an actual cap rate, whatever it is in the market. If let's say Nashville, Tennessee has a 5 cap, if you're able to buy a property at a 5 cap and add value, increase your NOI, that's where you're going to make a ton of money, because the cap rate is going to go from a 5 to, let's say, a 7. You've already increased it to a 7, but the market's selling at a 5. You can refi it back at a 5 cap or sell it at the 5 cap. So that's what you're really focusing on. You're always focusing on increasing or adding value. And I think that's the big difference between multifamily and single family homes. And multifamily, you have the control to do that, but you have to know how to do that. And you have to be able to spot value in properties.
Got it. Okay. So, okay. Just for those who, again, don't like, that's still over their head.
So Don, what I'll do is, on the show notes, I have a Real Our Profits book. It's a PDF copy. Anyone wants it, just email you or email me, and I have cap rate definitions, and I have the three step framework that we talk about. I'll send them a PDF copy for free. They can dive into that. They can dive into all the definitions and dive into all the formulas of multifamily. So I think it'll make it a lot easier for them to understand that. Okay.
Yeah. So, absolutely. And that would be great. That'd be fantastic. What I'm digging at is valuation of the property. And so the cap rate comes into the valuation of the property. It's not necessarily like you can have a 6-plex, and, right down the road, have another 6-plex, and they won't necessarily be valued exactly the same if the net operating incomes are different, right? If they're not managed properly, and rents, because it's all based on the income of the property is the value of the property. And
yes.
That's what I'm digging in. Yeah.
And each property has, these properties are different classes. So there's A-class properties, which are brand new for the last 10 years. Those have lower cap rates because they quote unquote have less risk. Now the B-class properties are built within the last 30 years. They are white collar and a mixture of blue collar. They're still pretty good, right? C-class properties are the ones that have a little more risk because they're blue collar workers. Their rents are less. They're older. They're 30 years plus. They have a lot more deferred maintenance. So those cap rates are going to be higher. So let's say a property in Nashville's got for an A property is a 4 cap. For a B property, it might be a 5 cap. For a C property, it might be a 5.5 cap. And for a D property, those are the war zones. It's just, they're more difficult to manage. You buy a property there, you'll reposition it. It's still a tenant base. It's still very difficult. So I try to stay out of war zone properties, war zone areas. They have higher cap rates because there's more risk in those areas. And how you find cap rates is basically going CoStar reports, having the network with the brokers saying, hey, what is trade in the last 6 months here? What are the cap rates? So you want to compare a B property. If you're buying a B property, what's a B property with a pool, with these amenities? And then you want to buy it with that actual cap rate in the market, knowing that you can add value to your property. So your 5 cap is actually going to increase in value.
Got it. Perfect. Scaling in the multifamily business. What does that look like? Like, what are the challenges? Share something with me on that.
So the challenges right now, Don, believe it or not, are difficult because blue collar workers are harder to find now. We've actually got at the 53 unit person threshold, we're actually implementing health insurance for our employees because, Trump, whether you hate him or love him, he's brought back manufacturing to a lot of the cities, and Louisville is one of them. And it's harder to find maintenance techs right now. So it's really competitive in certain markets to find maintenance techs. So that's one place where we've struggled to hiring them, and you got to pay them more, right? So ironically enough, though, their wages has been going up, but what's been going up also is rents. So it's a weird thing. You get the wage growth, but you get the rent growth too. So it's, I think multifamily is a hedge. And if you look at it traditionally it's been rents traditionally have gone up maybe 2% in the last 25, 30 years, but in the last 7 or 8 years, they've gone up in 4 or 5% in a lot of the markets because of inflation, because of also wage growth. So multifamily, definitely has been holding on and has been staying up with inflation in a lot of the markets traditionally. I think one of the things with scaling up, it's really, really cool. When you first buy your property, we bought our first 25 unit property. We had a resident manager on that property. Jake was managing it day to day, but the resident manager was there. He was able to let people in the units. He was showing the units when we had to open up for somebody to do some construction. He was on the property. He was part-time, older gentleman, part-time. Same thing on our second property. We had a different resident manager on that property. When you get to around 100 units in multifamily, that's when you can really start saying to yourself, especially depending on the market, you can hire that full-time property manager and that full-time maintenance tech. So that's what we were striving for, that 100 unit, and we got that in our third deal. Scaling up, it can be tricky. It's a business. So if you don't have the fundamentals of how to scale a business, and we've gotten coached, we've gone through the Rockefeller habits and scaling up and learning how to do that. And I think everybody should do that, because if you want to be in this for the long term and build a business and have people work with you and for you, if you don't know how to do that, you're going to be that landlord going out there doing all the work yourself and doing the paint and the rehab. And there's value in that, but ultimately the value is in buying more deals and growing the portfolio.
Okay. What's the future hold for you?
I don't know. We do our quarterlies. We do our yearly priorities. We have a meeting next week. So we try to meet with the whole team once a quarter just to get quarterly priorities down, which is important because Jake and I like to machine gun everybody and give 50 priorities and try to get everything done. And we found that that's not the way to do it, because it puts stress on everybody. Just because Don and Gino can go 100 miles an hour doesn't mean everybody else can go 100 miles an hour at that pace. So setting quarterly priorities for us, we're trying to buy good deals. We're trying to buy deals that are in our markets. We're trying to scale up because, like you said, the 52 unit was a little bit small for us, but since it was next to a couple of our other big properties, easy to manage. The management team is already there. We have the infrastructure there. We actually got a maintenance tech from this purchase. So he's going to be servicing our other properties too, which is great. Continue to grow the education, continuing to grow the property management, continuing to grow our investor base and buy more deals. And that's basically what we're looking for in the next 12 to 18 months.
Cool. Tell everybody how to get a hold of you if they want to reach out.
JakeandGino.com. My email is Gino@JakeandGino.com. And like I said, if you want, email me or email Don, and I'll send out a copy of that Willpower Profits book for you. We just launched our second book, The Honeybee, that shows you how to build complementary streams of revenue. If you want to go check that out, just go to JakeandGino.com/honeybee. You get some information on the book. You have some videos there. It'll show all our podcasts on there. It's a really cool book. It was written as a parable. So if my wife and my kids like it, I guarantee you guys will like it too.
Very cool. All right. Well, if you got value from this episode, make sure you're sharing it out there on Facebook, wherever you are watching it. And make sure you are subscribing to the show wherever you're listening, on iTunes, Stitcher, Google Play, iHeartRadio. We're everywhere now. And of course, go to the Flip Talk Podcast with Don Costa page and make sure you like that page and get the notifications. We go live because this is literally the last time that I'm going to be going live as I record. Every single time I'm going to start doing these at a specific time on a specific day. And it will be on the Flip Talk Podcast page with Don Costa. So, and if you are part of something in your business where you're growing and you're struggling and you want to be part of a community and you want to be part of a mastermind, and make sure you're going to beinThisRoom.com, because we are building one incredible mastermind community. We've already had 2 incredible meetings, and we're just building an incredible group of people that are looking to build a better business. So beinthisroom.com, check that out. Man, thank you for being with me today. I really appreciate it.
Don, thanks again. What was the name of that? Beinthisroom.com.
Beinthisroom.com.
So everyone's got to get on that site, Be in This Room, because that is the measure of success. If you can surround yourself with amazing people like Don, I'm telling you, it's like pouring gasoline once again on the fire, because you have smart people. They're probably smarter than you and me, and you're going to learn from them. And it's just the network and the richness of connections. And that's what life's all about. It's all about connecting with others and learning from others. So beinthisroom.com, everybody. Seriously, go check it out.
Yeah, appreciate it. So thank you very much. Have a good day.
You're welcome. Take care, everybody. Thanks.